The word that is being used out there, which I think is the right word, is manufacturing liquidity. In the old days, nobody ever manufactured liquidity. And there was kind of this situation where, let your winners run and let the market generate liquidity for you, which is the way it was. But now you're seeing that doesn't exist anymore. And so now it's about manufacturing liquidity.
Hello, fellow data nerds. My guest today is Hans Swildens. Hans is the founder and managing director of Industry Ventures, which started all the way back in 2000. Industry Ventures is one of the pioneers in secondary market for venture capital, managing several billion in cross assets, including like LP stakes, direct secondaries, and primary investments. In October 2025, Goldman Sachs announced that they were going to acquire Industry Ventures in a deal worth over $900 million. Hans, welcome to World of DAS.
Thank you, Auren. I appreciate your time and being on your show.
I'm super excited. Now, you and I have been friends for a long time, and you've been doing venture, as I mentioned, really long time. Venture secondaries for a really long time. When you started, it was kind of like a nothing. It was super small. It was really tiny. There was almost nobody doing it. Last year, I think 70% of all VC exits were to secondaries. Walk me through that last 25-year transition.
Yeah, we started doing secondaries after the dot-com collapse in 2000. So we were one of the handful of first firms that were started to are dedicated to doing secondaries. And so, my background, as you know, is as an entrepreneur. I helped my brother start two software companies. The one that was the most successful was Speed Era Networks. And so when I came to the market, the venture market, I came to it from the entrepreneurial side of the market. And so when I looked at the venture business, I didn't want to just create a traditional venture fund because there was already hundreds of those. I wanted to look at how we're going to invest capital in a differentiated way, and then have kind of over time pick a segment that we think could grow and kind of help the market evolve. And so, when we started, it was nascent. Basically, all the transactions that were happening in the market were from corporate venture capital funds winding down, from some mutual funds selling some assets, and some hedge funds.
And you would buy, the fund would have invested in, let's say, 30 deals, maybe 10 were still ongoing, and they were kind of like ragtag of some good ones, some really bad ones, and you'd buy that kind of remaining fund from these kind of corporate venture capital firms?
Yeah, I mean, most of the portfolios that we bought were built in, 97 to 2000, the bulk of it being 1999, 2000 investments. Because that's when the corporate venture funds kind of went from being like 100.
I assume because of that, many of them were underwater because of the dot-com crash and stuff like that.
Yeah, I mean, it was distressed. I would say the beginning of the secondary market for venture investments was a distressed opportunity. The portfolios were distressed. And
they just wanted to wind down the fund. They were just okay, we don't need to do this anymore. We're X firm, and we don't want, we actually make money selling software, selling widgets, or selling consumer packaged goods. We don't need this venture capital arm anymore.
Yeah. I mean, the companies themselves got distressed too, right? So the corporate entities got distressed, and their portfolios got distressed. And then the whole venture market was distressed, and then liquidity disappeared. And so you had the whole venture market became a distressed market. And so the transactions that we were buying were all distressed portfolios from distressed sellers. There were some interesting kind of nuggets in these portfolios and companies that ended up being, great, successful businesses. But at the time we were acquiring them, it was more of a counterintuitive kind of value investing strategy of going into the market looking for, distressed deals, but from distressed sellers with some good assets, but most of the assets were also distressed. And so
it gives us a sense, how big was this? I imagine the market was really tiny back then, the secondary market.
Yeah, the first couple of years there was only a couple $100 million per year that was traded. Most of it was in portfolios. And most of that was in corporate venture fund portfolios. There were a couple mutual funds, a couple hedge funds, but there were about 30 different corporate venture funds that sold their portfolios in a 2 to 3 year period. And so the bulk of the pricing was really poor. The pricing went down to 10 cents in the dollar, 20 cents in the dollar, 30, 40 cents in the dollar. So people were taking, 60 to 90% losses on their cost. And, it's just a very distressed time. Some of the
And
companies were
how,
bankrupt, right? Some of the companies went
yeah.
bankrupt too. It was the time when you had, Tyco and Williams Communications and Enron and MCI, WorldCom, and we had a lot of different companies that were going through bankruptcy processes as well that previously started up venture portfolios.
And give us a sense of the magnitude of how much has changed in the last 25 years. Like, where are we at today in terms of like the broader secondary market?
Well, the sellers back then were mostly distressed. The portfolios were distressed. I would say that the market's completely changed. Most of what's being sold today, people are taking gains on rather than losses. And so it's flipped in that regard. And then most of the sellers are healthy. And so, the transaction types now in this market went from like 2 or 3 different transaction types to maybe 10 or 20 different transaction types. And the sellers went from, a handful of sellers to everybody in the whole market selling. And so previously, when we started, venture funds themselves were not selling. That didn't really become a thing until Facebook kind of triggered the acceptance of that in 2009 and 10. But the market,
and they might be taking they might be taking like some of their position off the table so they can de-risk it a bit.
That's right. So today, the liquidity of venture itself is difficult, and so you're seeing some numbers now that are pretty high, some shocking in terms of the percentage of liquidity coming back to the market, which is the funds and the companies and the shareholders that are secondaries. One number was 70%. I thought that was really high, but then I started digging into it. It might have been accurate. I think that came from Tom over at Theory. But when you look at what the market is today, it's really developed into a fully functional, very dynamic market of generating liquidity across company shares, fund positions, direct portfolios. There's even continuation funds that structure has been created. You've got option exercise loan transactions, which is a market that created. You've got forward transactions that were created. So you have the securities that previously the market was illiquid. Securities weren't sold very much. And now you've got a very dynamic, large market. We think it's over 120 billion. This year, it should be more than that in terms of transaction volume. And then on top of that, you've got the structuring and sophistication of how securities are being purchased and sold has gone up many different levels. We're probably still in terms of innings. If it was a baseball game, we're probably in inning 5 in terms of sophistication, maybe 4. But so we have a lot to continue to innovate on here. But I would say, the market's gotten highly sophisticated, helping venture funds get liquidity on their portfolios, helping their LPs get liquidity on their portfolios, having corporate venture funds, hedge funds, mutual funds, traditional limited partners like endowments, foundations, pension funds, pretty much all the constituents in the venture business today, from the GP side, the LP side, and the direct side are all using secondaries for liquidity management.
And not only that, I think a lot of them are actually buying secondary. Like it used to be like the buyers or secondaries were like you guys, and maybe some like back in the day, there was like Ken Sawyer from Saints and Ben Black from Acadian, and maybe like 137 came at some point. But now it's like even like the big venture capital firms are also buying secondary or selling secondaries, and they're buying secondaries too.
Yeah. I mean, it's similar to what's happened in the buyout market. So when we look at history and trends and kind of the data, which is important, what's happened is our market, the venture and tech growth market, has been borrowing and adding in liquidity structures that have been in the private equity market, which is mostly LBOs, but also traditional buyout, in terms of how they've been getting liquidity. And so pre-2000 buyout funds didn't sell to other buyout funds, and then between 2000 and 2009. It became over 50% of all exits were buyouts funds selling their companies to other buyout funds. And so they called that sponsor to sponsor.
Yeah, by the way, like
exits.
it's extremely rare today to not sell to another PE fund, right?
That's right. And we've kind of moved, our market's kind of moved into that realm, right? Where so, the big question that we'll have to ask ourselves here is this going to change, right? And every year we think that it might change in terms of go back to IPOs creating liquidity, traditional strategic M&A creating liquidity, but every year the number keeps accelerating and the market becomes more of a sponsor to sponsor market. And so if we're sitting here and last year, if that number is accurate, with the 70% of all liquidity was from secondaries, seems high, but if it was accurate, that's more of like a buyout to buyout market. And if we're in that zone, might not change because the private equity market hasn't changed, right? They're not getting more liquidity in different avenues today than they were before. They are getting more liquidity with continuation funds. So that's kind of like the one thing over the last 10 years that's accelerated in the buyout market is instead of going sponsor to sponsor, they're going sponsor to secondary fund CV. So they're continuing to hold their portfolio
Yeah,
companies.
which is kind of like but with the same GPs or something like
That's
that.
right. And so we have that in our market, which started accelerating about a year or 2 years ago in terms of more
Like
and more.
Sequoia has one, and a few other like well-known companies have built one as well.
Yeah, I mean, as you know, I can't talk specific deals,
Yeah.
but there are a lot of larger platform kind of venture capital firms that have been using continuation funds as a means to get liquidity back to their LP
And
base.
even the LPs themselves seem to be like somewhat sophisticated where like sometimes the venture fund will give the LP the option of whether they want to sell their stake. Or like I'm an LP in a couple funds. One of them, let's say, is in Stripe, the other one's in SpaceX. And I've seen like multiple things come in almost like every year, multiple times I've had the option of selling my stake or a portion of my stake into some sort of secondary. And so the fund says, hey, you can keep riding it or you're not. Whereas before the fund would just like make a decision, either sell or not sell for me.
Yeah, I mean, we call those GP leds, but they're giving the LP the decision, right?
Yep,
So the
that's right.
GP is leading the secondary sale, but they're giving the option to the LP to either sell or hold. So there's also the LP side, which is if you're an LP in that fund and you just want to get total liquidity and not get partial liquidity, you can go and sell your LP stake as well. So
Yep.
there has been a lot of innovation around the GP led market in the venture business. I would say we're very early in the innings there. We're probably in inning 2. When if you look at the buyout market, they're in inning 6 or 7. So they've been doing continuation funds in that sort of structure for a long time over the last 10 years. And so the LPs that are in both buyout and venture funds have been very familiar with that because they've been getting the same option in the buyout funds, and they've been starting to try to teach the venture funds how to do it. There was a period of time where ILPA, which is kind of the governing body of limited partners, that they are going through decisions whether or not it was a good or bad thing in terms of these continuation funds and how it was going to develop in the buyout market. And I think what they determined over time is it's a good thing as long as there's an option given to the LPs, because the LPs can continue to go if they want to continue on and not sell, or they can sell if they want liquidity. And so as long as there's an option to select yes or no, and it's not forced, you've seen that the LP market embrace it because it gives them another option to get liquidity, right? They don't have to if they don't want
and every LP may have a different time horizon, may
That's
have
right.
different needs, and so they can make a decision, which I think is great. I mean, it does create the burden, but it is really great.
You just want to give people the option to decide on their own themselves, right? Is the reality.
Now, also, employees have more options as well because these companies are running tender offers because they're staying private for longer, and they're controlling all these different things. Nowadays, like I don't even know if it ever even like if your company's doing super well, like what is the incentive to even go public? Like, why don't I just stay private forever? Like in some ways, maybe Stripe or SpaceX, like they stay private forever.
Yeah, if you were leading one of these businesses and you are the founder and CEO still, which in those two cases that's still the case, you might decide not to ever go public, right? If the markets are functioning and letting you generate liquidity and raise capital if you need it, in a manner that's better for you, in terms of the business, better for you managing the business, also better for the business itself. You're just going to stay private as long as you can. Um, and as long as they continue to offer liquidity to shareholders, offer liquidity to the LPs that are in these funds that are shareholders, and the market's functioning, getting people the liquidity they need, there's nothing to force someone to go public, right? And so,
Plus, it's like
why
public
would
has
you?
all
So
these burdens,
if you're,
right?
yeah, I mean, if you're in that zone of, um, you're able to do this, and you're able to have the liquidity that you're managing, do it often enough, and have it at scale enough, which are two difficult things to do. There's not a need to go public, and why would you? Because you can continue to offer liquidity to your shareholders and also the shareholders LPs in a format that makes them happy, as well as you can go run your business and make long-term investments and be more strategic with it. Maybe not generate as much cash flow as you would have to if you're public, and reinvest that into growth, and continue to compound at rates that you might be able to not compound at if you are public. So there's an incentive if you want to continue to grow at a certain compounded rate and reinvest your profits, and not, run it as a public company, which would mean you'd have to be more profitable. You're incentivized to stay private. So yeah, it's not surprised. I think, that the issue there is that you need two things, right? You need the amount of demand for your stock to have lots of capital available when you have your window of liquidity, that it's filled, right? You need to be able to fill your liquidity window. And then you need to have enough growth in your business and to be performing well enough where, you can go execute on that as well. So, so it's tricky. I think, you've seen some of these companies fall out of that window where they used to be able to do tenders and now they're not, or they are still doing tenders and they're able to do bigger and bigger and bigger
Would it be
ones.
better to be a fallen public company at that time? Like, it doesn't seem like that's like the
Maybe,
better
maybe
option,
not.
right?
Maybe not, because as a fallen public company, you might be trading at $1, and then you can't get, if you're not more than $5, you can't be in a mutual fund's new portfolio purchase and stuff like that. So the answer is it depends.
Yeah.
But you could be put in a penalty box as a public business where you're restricted from being purchased. Your securities are restricted from being purchased by mutual funds, hedge funds, and others, just due to how much liquidity your stock has per day, what the price per share and your valuation is. And in that, if you're stuck in that part of the public market, you're actually probably better off being in the private market, because you might have a better option for
Yeah, it seems
raising
like in
capital.
almost every scenario, it's better to be private, unless you're like a meme stock, or you're like you capture like the imagination of the consumer investor somehow, which many companies have, and then it becomes even easier to raise capital or something. But if you can't capture, if you're just like a boring enterprise software company, it seems like unlikely you're going to capture the imagination of the public investor.
Yeah, I'd say it's tricky. The game is tricky if you were a CEO and running one of these businesses. You don't want to run into a situation where you can't continue to do the liquidity structures, right? So, or you don't want to be in a situation where you try to do liquidity, quarterly liquidity or monthly liquidity programs, and then nobody does them anymore, or funds them anymore, right? So you don't. I would say if you're in the public market, which is liquid every second or every millisecond, you can people can get liquidity at any time. I think the
Yeah.
risk people have with this, which there's obviously a trade-off when you decide to do things like this, is that the liquidity windows are finite. They're typically once a quarter, and so they're episodic. And then the demand for the shares, or for the liquidity to provide the liquidity, is potentially episodic, right, as well. And then the valuations are episodic, and so it's not something that is super liquid that can be worked on all the time. The hedging of the securities also it's not as good, because we don't have a good way to hedge these private securities, when in the public markets you have the derivative markets. And then in terms of raising debt, as a public business, it's easier to raise debt, because there's a larger buyer universe of people that will provide the debt due to you being public. And some of it, their requirements is
And they can
that you
understand
need
your
to be public.
financials better.
Yeah, you just need to
Yeah.
be public. terms of why you don't have to go into the private credit markets, right? Which is what you would do if you're a private business. You can just go into the more liquid public credit markets. And so there's reasons to
So
go
even that
public.
has changed dramatically, right? I mean, the private credit markets have grown so dramatically, even in the last few years.
That's right. Yeah, there's more and more private credit buyers, and private credit's become a huge asset class on its own.
Yeah,
Providing the credit to these
and
private companies.
many PE firms are also private credit firms, right?
That's right.
And there's
And you're
almost
starting
lent
to
to
see
themselves.
VC funds being private credit firms too, by the way. So you'll see more and more credit products coming out of venture funds as well.
Oh, you think we'll see more? You think even to earlier stage we'll start to see credit
Definitely,
happen?
definitely.
Interesting.
Yeah, the credit markets are the part of our market that I think is going to have more and more innovation on the venture growth side than people think.
Yeah, that makes a lot of sense, because today it is a little bit opaque. It's hard to do it, and you could start to see a lot more innovation. And now we're seeing more VCs that are RIAs, where like just a few years ago that was more rare.
Yep.
To see VCs that are RIAs, and today like Andreessen and others are RIAs, so they will have more opportunities for these VCs to get into things like lending and other things that before they were excluded from.
Exactly. Yeah, you're going to see a lot more innovation in our market and venture growth. The credit markets are going to have a lot of innovation here. And then I think the equity markets, you're going to see that have some more innovation too. And then also fund structures and how funds are raised and the duration of those funds. I think you're going to see a pretty massive change in the next 10 years of how that works in terms of just how people raise venture funds and also secondary funds. So I think there's just been
And what do you mean they're going to raise it more from consumers, or?
I think you're going to see both. You're going to see they're going to have private vehicles that are long duration, permanent capital, hedge fund like vehicles, more and more of those. And then you're also
with like some sort of like a yearly liquidity opportunity for the people in there.
Yeah, I mean, there already are in our market less than a dozen of those. And I think you're going to see that structure continue to evolve. And I think,
and they just kind of like market through some sort of like, because today it seems like the marks for these private companies are a bit all over the place. Mm-hmm. It's easier to mark on a public company, but you'll think there'll just be a more coalescing of like how they mark these marks.
I think that the valuation, how things are valued in this market for the last 25 years has been improving and improving and improving. We didn't have foreign NA valuations. We didn't have FAS 157 valuations. If you go back 25 years ago, there wasn't really a good valuation construct.
Yeah, third-party valuations. I mean, often you just like make it up and stuff, right?
So I think that valuation sophistication in the market's been increasing, and there's been multiple different third-party valuations are done, both at the company level and at the fund level and at the security level in the fund. And so you've got that's getting better and better, and I think becoming more standard. And then you also have, so if you look back, why do thousands of venture funds today use the same limited partnership agreement they did in the 80s?
Yeah.
Why is there a 10-year term, 2 1-year extensions? Why does that exist when why does it exist when it's outdated?
Yeah.
And the number of firms whose venture funds last until year 10 and then they liquidate them, or in year 12 and they're liquidated, is dwindling. So a lot of what's happening.
Yeah, usually you get the LPAC to extend it,
like
and
year
then you
13,
keep getting
14,
extending
15.
it.
I mean, it's and continuing.
I'm an LP in funds that have been there for 20 years.
That's right. So the construct, I think, of the underpinning of the legality of and the terms and conditions of how venture funds raise capital, I think, is going to evolve. And you're starting to see that evolve now. And then I think in terms of the LPs that are in the fund, if it is a partnership, because it could be not a partnership itself. So if it's the LPs are changing, and so you have the situation that historically, venture was funded by a set of high net worth billionaire families as well as endowments,
Yep.
right, in the 80s. And now you have a situation where you've got the largest growing pool of capital is individual retail and high net worth capital is flowing into the venture business. And that is something that's happened over the last 5 to 10 years, and it's continuing to accelerate. And then you've seen some structural things with recently, planned 401k access to the private markets being approved, and other things of like structural changes making to different laws, different security laws that are allowing more access to private securities. And so that how that's going to affect the actual investor base of a venture fund like the one that you manage. I think that's going to change over the next 10 years dramatically of the type of investors that are investing. And then there are
also, like today is you have things like QSBS, you have these, so
Yep.
And you have different kind of tax rates. So for like the individual US taxpayer, like for a fund like us, like in Flex Capital, most of our LPs are actually high net worth individuals, because the after tax return is just like so dramatically different if you're getting QSBS and some of these other kind of nice things that
especially if you're
when
a
you're investing in
California
this economy.
taxpayer, right? The California taxpayer.
Yeah, well, California doesn't get QSBS, so that's the one kind of downside. But if you're a New York taxpayer, you get like massive gains for this.
Yeah. So QSB is pretty important in terms of like your underlying. If you're a seed investor and you qualify for a QSB, your treatment. And then if the capital base in your fund is like yours, more individuals, right? And that'll also how your partnership's going to be structured in the future in the next 10 years, I think is going to change. So I think it's, there's the lawyers in the market, the GPs in the market are evolving now in terms of their thoughts. The LPs that are coming into the funds are requiring different things. So some of the registered investment advisors or wealth managers now want tender offer funds or registered funds that have liquidity structures in them rather than just a normal limited partnership. They don't want a K1 going back to their investors that they're managing money. They just want it flowing through like a normal mutual fund report would. There's no delay in a K1. They don't have to collect K1s. It's already just in their accounts.
Yeah, K1s are super annoying.
So you've got administrative needs. You've got capital, liquidity needs. You've got capital, the type of capital that's coming in, their investment size, their qualification. It's all changing. So, I think that, you're never going to have the traditional venture fund structure probably get completely changed. But I think that there's going to be a lot of innovation here. And especially if the credit markets on the venture growth side start evolving and that's added into these vehicles, then you're going to start having situations where you have a vehicle and it might hold equity and credit. And the credit is a yielding credit, which could pay for redemptions off of the investor base. So even if the equity, you can't get redemptions or generate liquidity there, you've got liquidity with a debt sleeve. And so that will evolve into more of a perpetual vehicle that you could offer to investors. So you've got a lot of innovation happening, I think, on the fund side of how things are going to evolve.
And for an investor like Flex, what would be your advice to us? Like, we have these opportunities. We're investing in a company at seed. Now the company is raising at a multiple, let's say, $1 billion plus valuation. We have an opportunity to potentially sell some of our stake in it, but we also want to be supportive of the company. We don't want to show that we're a seller because we want to have that relationship with the founder. We get a lot of referrals, so often we don't do it because of that. Like, how do you think firms like us should start to think about this in a more sophisticated way?
Well, I think that's the one thing that the venture fund managers themselves need to spend time on. And a lot of them are, and some of the larger firms that have more, capital and people are staffing full-time people to deal with this question. So liquidity management, fund management, investor liquidity, company liquidity management. So there are partners now that are being hired or managing directors at these larger venture funds, and that's their sole job. That happened in the buyout fund market already. It's happening now in the venture fund market. And so the question that
there's sometimes there's a separate partner whose job it is to
100% all they are
decide.
doing is this.
Yeah.
And so the question is one that's hard to answer unless you understand the situation of where the fund is in. What situation is the fund in? Is the fund 100% returned? Does the fund have a 25% net IRR? Is it sitting there with 100% DPI and 25% net IRR, and is it at a 4x? So if it's that, then maybe you don't need to sell. Maybe you should hold.
Your investors are already happy.
Keep compounding because your investor base and your LPAC would rather have you hold and keep compounding and go for a 7x fund instead of a 4x fund. And you can take more risk. But if your fund has no DPI, if your fund's at a negative IRR or single digit IRR, and you have an option to take 20% of a position off at a 10 times return, I would say you should probably do that for your own LP management, your fund management, and being a fiduciary to the LPs. I think it's the right fiduciary decision to get some liquidity because you had none and the returns haven't started showing up yet in the book. And so that helps generate, some returns in the book too, right? Because you're having an exit, you're marking your NAV to that value, and then you're getting some DPI. So if you're improving your IRR and DPI and getting it to a point where you can return all your capital plus have a nice net return to your investors, you're doing your job, I'd say. But we do that.
Hey, you guys
we do that in our own funds. We manage our own funds and have liquidity plans and structures around each one of our funds. We have portfolio analysts that is looking at every single fund, every single position, trying to determine, what sort of liquidity we need on the fund. I think the word that is being used out there, which I think is the right word, is manufacturing liquidity, right? People need to venture itself in the old days. Nobody ever manufactured liquidity. It was like,
you just
shows up, right?
Yeah.
Like if you talk to older venture capitalists, and now we're one of those, but like the ones that are even older than us, they'll say, "Oh, companies are never sold; they're always bought." If the company is good enough company to go public, it will. And there's kind of this situation where let your winners run and let the market generate liquidity for you, which is the way it was. But now you're seeing that doesn't exist anymore, or it's changed, and so now it's about manufacturing liquidity. And so people need to start thinking about how to manufacture liquidity. It's not only through secondaries, by the way, it's also through tech buyout. So tech buyouts become a major, it's 25% now of all, exits to venture funds. And so when you think about, it used to be 2%, now it's 25. So private equity firms are coming in and buying these venture capital funds either as add-ons to their existing private portfolio companies, or as new portfolio companies as like a new co, and then using it to aggregate and make it a core holding in their buyout fund. And so I think venture funds also need to understand how to exit their companies to buyout funds, which historically they haven't done as much, but it's happening more and more. And when buyout funds buy companies, they also typically offer a rollover. So there's a need to understand when a buyout fund comes in, how do you act with the buyout fund so that you can either do a rollover or not do a rollover or partial rollover. And so there's situations where if someone's coming in and buying your position, you own 20% of it, you could sell all of it to the buyout fund, you could sell half of it to the buyout fund, roll half, you could sell 2/3 of it and roll a third into the buyout. And so there's different ways with buyout funds to manage liquidity of your own positions there too. And I think a lot of venture funds don't understand that when a buyout fund comes in, that they actually just roll their whole stake, or they could roll half their stake, as long as
we probably had, I think we had 4 of those happen in 2025.
Mm-hmm.
So I mean, it seems,
did you just generate
maybe we had one that happened in 2024, and in some cases, like we sell 45%, some cases we sold 20%, some cases we sold 100%. It really depended on the situation.
Yeah. So, I mean, there's a lot of, that's why this has become a full-time job, right?
Now, you guys also have a fund of funds, and I could see how a fund of funds works really well with the secondary part of the business. But what have you learned just from like the fund of funds side of things?
Well, our hybrid fund of funds is a mix of primary commitments to venture funds that are small, so typically sub 150 million of fund size. And so we're focusing it on the smaller venture funds. And then we're also doing co-investments in buying secondaries in the funds, early secondaries through the same partnership itself.
Yep.
And that's for generating the right liquidity model in our fund.
And you guys won't even invest in like SPVs that these funds do and stuff like that.
So we do co-investments through SPVs, pro rata right co-investing. We do direct investing. We do LP purchases of the small funds, and we do primary commitments to these small funds. So we have one of the largest programs in the U.S. of doing that. We've got 150 small venture funds we've done this with. It's one of the largest portfolios.
That's a lot, by the way. Really means you're one of the biggest LPs in funds. In terms of number of funds.
Number of funds for sure.
Yeah.
In terms of dollar amounts, we'd have to figure out where we sit there. But yes, we're one of the larger by number of funds investors in the U.S. into small venture funds, and we probably have one of the most active new fund commitment portfolios in the market in terms of funding new venture funds. But when
I look at the market, it's kind of it is kind of interesting how like all these things are like somewhat competing with each other. Like you're an LP in all these funds. In fact, like some of the other biggest LPs that I know of all these funds are like Mark Andreessen and Peter Thiel. They're in like so many of these funds as well. Maybe individually, maybe not part of their fund, but kind of still somewhat related, right? They're doing secondaries, you're doing secondaries, you're doing primaries now, right? So it's like all these things are like somewhat converging in an interesting way in the market.
Yeah, I think that was kind of misunderstood by a lot of people related to the venture market. And I actually misunderstood it myself for a while as an entrepreneur is the larger equity investors in the venture business that manage larger pools of capital end up investing capital throughout the market. So we've in our secondary funds bought some LP portfolios from some of the most sophisticated, largest equity investors in this market, and their individual personal accounts. And that historically, really wasn't a thing. And then, but what's happened is as the asset class has grown and grown and grown, and as their fund sizes have grown and grown and grown, they've continued to participate personally or through their funds, but a lot of it's been personal into these smaller funds. And so you have this situation where you've got a kind of a collective karitsu, right, is probably the right word, of networks, because they cross, like, for example, our relationship with you. We were an investor in LiveRamp. We did secondaries in LiveRamp. We also are an LP in Flex through secondaries, right? So, and one of the reasons why,
we've had a long relationship of working
one of the reasons
together.
why I was excited to talk to you and why I do some of these things sometimes is because it's with people that we've known and worked with for so long. But if you look at that, what happens to you if you've been in this industry for 25 years and you're becoming at scale with your capital base is you end up participating in different ways with all the people that you used to participate with. As an entrepreneur, you become an LP in their fund. If you used to work with them, you become an LP, investor in their seed round of their company. And you end up having this kind of collective network effect. So it's most of the people that are running these larger asset management or venture capital platforms are invested throughout all the market, right? Sequoia has a fund of funds for smaller funds. They have their Scout program. They've got their, seeding program. They've got all these different things. And so it's not just early stage venture capital there anymore. And the same things happen with all the other platforms as they've developed into kind of multi-stage, multi-product, multi-LP, GP hybrids. I think, in terms of like just venture itself, this is kind of how the business works, right? People switch between being an entrepreneur, being an investor, being back to an entrepreneur. You've got capital trying to work with the best people in the market that are creating value. And so the capital finds a way to flow into these different structures with different people.
And when I think of traditional PE, traditional private equity, I don't really think power law. But when I think venture, even secondary, it seems like it's so driven by these massive outcomes that happen. Like, how do you see that as a big difference, or do you disagree, or how do you see the markets
Yeah, I mean, that one I disagree, just because when you look at um, secondary funds returns and you look at on a deal by deal basis, traditionally secondary funds underwrite transactions to a lower multiple and a higher IRR. And so, because you have to the way the market prices securities in the secondary market is to a lower multiple and a higher IRR, is if you're doing your
Yeah.
job right. And so, like, when you have a secondary fund and you look at your portfolio construction of all the deals you're doing and everything, it's actually the reverse of a venture fund, where you're wanting to have a low loss rate. You want to have, if you're doing your
Right. So
job
more
right,
like
you
a
have a
private equity fund, right?
looks
Like
like a
the
private equity fund in a way,
yeah.
but it's more indexed. So because you have less chunkier positions, and so you've got to be more accurate around what's going to be selling for 2x or whatever return you're underwriting to within a certain period of time. And so, and because your multiples are on average lower than a venture fund, they should be, or more of like a traditional buyout fund, you're gonna have more and more deals that are gonna have lower and lower multiples. You're gonna have higher IRRs. And if you're managing that correctly, and if you're managing your portfolio correctly, it looks more like a it's between a venture fund and a debt fund portfolio construction.
Yeah.
Um, it looks more like a traditional private equity fund in a way, but it's not. But it has, maybe the positions in the fund are 100 positions, not 10 or 20 positions. And so you have a situation where it looks kind of has a yield to it. You are generating, even if you do 100 deals and you're wrong on timing of like half of them, and you're right on the timing on the other half. Maybe some will be accelerated exits, some will be delayed exits. But when you do your construction, you'll see over time that it operates a little bit more like a hybrid between a traditional kind of venture fund and a credit fund. And that's the right way to think about it. So yeah, and if there are outliers events in these venture secondary funds, which happen in venture funds because that's just venture itself. But typically, when you remove those from these funds, it looks more of like kind of a hybrid construction between a credit and equity fund.
Now, acquisition of venture funds and funds in this market are incredibly rare. Um, obviously you guys agreed to sell to Goldman Sachs, which I thought was very, very interesting. Do you think those types of acquisitions are going to become more common in the future,
I
where the
do.
funds themselves will sell, not just secondary?
I do. Yeah. One of our predictions, I went back and did a set of predictions like 4 or 5 years ago. And then I ran the article through ChatGPT to see what was accurate. And this was the one of the predictions that was actually not that accurate. So maybe due to our deal, it becomes more accurate. But yeah, I've predicted for a long time that there's going to be more consolidation in the venture business. It makes sense if you go and talk to the large publicly traded asset managers that historically come from the buyout market, but now are multi-strat, multi-asset management companies. In the U.S., there's over a dozen really large ones, and if you go talk to the CEOs of these firms, most of them don't have a venture growth part of their business, and
Yep.
so I think you'll see them add that. I think all of them, because I've talked to most of them, all of them have been considering adding it. Some of them have decided not to now. Some of them are thinking about it. But I think overall, it's an asset class that makes sense to have as part of a multi-strategy
I mean,
firm.
once there's enough fees, it's very easy to model, at least on the fees, what's going to happen. But on the carry, it's a lot harder to kind of understand. And
That's
then,
right.
of course, like these venture funds are often like driven by a small number of people who could walk out the door. So structuring these acquisitions, I imagine, are super difficult to do.
Yeah. I mean, you've had that happen in life sciences more. So, like, there was a handful of life science firms that were acquired. And
There were okay. What's the history of that? I don't think I'm aware of it.
Yeah. So, you know, I don't know which ones I can actually talk about, but like the ones that
Okay,
were
yeah.
public, um, I think Blackstone acquired, was it Abingworth? Um, Blackstone. Uh, so Claris, sorry. Um, there's a list of about 5 of these that were
Okay.
purchased in terms of
And
you know
these are like venture funds in the kind of bio world and the healthcare world.
that's right. Yeah, and then
Okay, interesting.
they've developed the strategies on the life sciences side of the market to invest capital across the innovation cycle of life sciences, and that includes drug discovery and financing, drug development and drug royalties and things like that. And
Oh,
so
interesting. You want to go like full stack from like
that's
the
right.
beginning all the way to with public companies or something like that.
That's right. So I mean, you've seen there's like 5 of them that were like that, where they bought a specific, kind of biotech VC manager, if you want to call it that, and then expanded what they were doing to help with different types of investments across the life sciences cycle. So I think that was kind of the first area that was added to some of these larger firms. And then you also had every one of these larger firms add a secondary fund strategy that's more private equity focused. And so,
Yep.
you had areas by Landmark, you had Blackstone by Strat Partners, which was from Credit Suisse. You can go down the list, and either they built or bought a traditional secondaries fund business that's focused mostly on private equity and credit, but they've expanded them into real estate and infrastructure and things. And so, in terms of venture and growth, I think you're going to see more and more of these types of firms go into this asset class, and I think you're going to see them go into it with acquisitions as well as organic kind of in-house development. It's both, and it just makes sense because the asset class is big enough now where it's large enough for them to add it. It used to be
Yeah.
too small. And then strategically, if you think about it strategically, if all your capital's put in credit, real estate, private equity, infrastructure, and some of those industries are going to be completely changed by AI, either in a positive or negative way. Wouldn't you want to have a portfolio of companies that are dealing with new technologies and AI
Yeah.
and
Hundred
developing
percent.
to apply
Yeah.
them to your industrial and traditional private equity businesses to accelerate EBITDA, accelerate growth, right? Which is what you're doing there anyway with your
And
operating
it
team.
seems like also like there's a there's a synergy where they really can help each other if the acquisition is done correctly.
I think that's extremely synergistic.
Yeah.
It's very strategic. Because what you're seeing is not only is value creation happening more on capital in the private markets, but you're seeing this AI innovation cycle, which is only like 3 years old, at least with the LLMs, is going to dramatically affect all these other industries and how they integrate that, um, develop products and services on it, and then sell that through to their customer bases, because it is probably going to continue whether or not their investments are successful or not in the future. Because they strategically are going to have these technologies in their operating companies to have them compete against the other competitors they have that are in these traditional industries.
And it seems like
So,
so many wealth management companies have been acquired over the last couple dozen years. How do you see? Do you see that's like a similar trend here, or is that like a model that we can look to?
yeah, I think that you've seen hyper consolidation in the wealth management sector. It's continuing to accelerate.
Yeah,
Most of the friends I have that have created their own wealth management firms have either sold them or they've been getting bids almost on a monthly basis to have someone buy them.
yeah.
Um, and so I think that that's going to continue. That whole sector is going to continue to consolidate, and it's not only in the U.S. It's going to do that worldwide. Um,
How do you
so
think the brands like? Because in some ways, like Industry Ventures itself has like this great brand.
mhm.
If you were called like Goldman Sachs secondary fund, or I don't know, it wouldn't
Yeah.
again, I don't want to speak to you, but like
Well, thank you. Thank
part
you
of
for
the
saying that our brand is good.
yeah
Um,
part of the
so
value of like acquiring it is like the brand, and like sometimes like in B2B software
mhm.
they'll call it like the Oracle random marketing cloud, and they'll kill the brand, and all of a sudden they kill like 50% of the value of the company.
Yeah,
How do you think like they should be thinking about it in this case?
yeah. Well, they've already thought about it, and we've already made a decision to keep it because of what you said, plus the fact that in the org that we're going to be a part of, which is the Goldman Sachs Asset Management. There's a division called XIG, which is their external investing division. That group, the funds themselves have to have a different name than Goldman Sachs due to regulatory reasons. So we're just going to keep all the
interesting. Okay, so it makes the decision easy, actually.
Yeah, the decision's there. We had to have a different name for the funds anyway, and the brand's good. So we've all decided to keep the brand moving forward. It's kind of a nice thing to have. And it's relevant in our market, right? Since we've been in the market for 25 years and we've got such a large portfolio, we're going to keep the brand and keep the funds under that brand name. And so yeah.
It's great also because, you probably have had hundreds of thousands of dollars of swag over the years, so you don't have to get rid of all the swag.
We don't have to get rid of the swag at all. And they have there's some swag they have that's really nice though.
That's true. It's a good point. That's a good point. I'll take some Goldman swag as well. Yeah.
Although we've tried to make a point of having good swag over here.
We've seen also like a different type of person who's like going into venture capital, going into these kind of careers today than maybe in the past. Like, how do you think that will evolve?
I think that it's going to depend on how the fund structures and the capital flows evolve. So I think you got to kind of backward integrate that one. I think today what we've seen in the last 10 years, we might not see in the next 10 years. So there's a little bit of what's happened. You can't assume it's going to continue to happen. But in terms of the last 10 years,
because we have these like solo GPs, we had these rolling funds, we had all these other kind of experiments.
In 2009, when we started funding sole GP funds, like the normal LP market didn't want to do it.
Yeah.
And so it's similar to the secondary market where everyone didn't understand why you'd want to do that. And so it's definitely counterintuitive again. But, in the last 15 years or so, you've seen the solo GPs explode. You've seen, when we started, there was like 30 solo GPs. Now there's like 1,000 plus solo GPs. And so in the future, if the solo GPs are still able to raise capital from mostly individuals, it'll continue to run in terms of its part of the reasons why we think that the solo GP and the small fund market has exploded in terms of number of managers is because there's been this retail demand, this individual capital demand coming into this market, and a lot of it's being filled in these smaller funds. And so, for example, you said earlier that most of your capital in your funds are high net worth individuals, right? And so, that is the case throughout the market. There are some funds that get raised that are small funds that get anchored by an endowment or get anchored by a large family office that's historically been traditionally anchoring venture funds. But most of the LPs that are coming into these new funds, it's a mix, right? It's a mix of where the flow is coming from, where the demand is coming from. And so, I think you'll start seeing the individual investors wanting to have structures that provide them more liquidity than they have today. I think that because of if this market stays illiquid, like it's been continuing to stay illiquid, and the avenues for exit are secondaries, tech buyout, and to a lesser extent IPOs and M&A, you're going to have to see the partnerships evolve and what they do. And maybe your fund will look more like a hedge fund next time, where it's open-ended, it's no term.
Yeah.
You've got a redemption feature. You've got these things in your partnership. Maybe there's a firm that provides the redemptions you cut a deal with an outside firm to provide that redemption mechanism. And someone comes in and signs a exclusive deal to provide, redemptions into your partnership, or maybe it's not exclusive because you have to offer it to multiple people, but you have 3 or 4 that go in there that provide a market for the redemption price, or maybe you mandate the redemption price as NAV, and then the redemption can happen or not happen depending on if the buyer counterparty wants to take that redemption. And so you've got a situation where like your structure of how you're structured, who's investing into you, what you're doing, I think is going to change. I think in the next 10 years, you're going to see this industry evolve and become highly institutionalized.
When I meet these, when I meet a high net worth of people, I'm surprised how few of them have any exposure to venture. Like they've got the traditional things. They've got the bond portfolio. They're in the S&P 500. They've got they're in private credit funds. They're in some PE funds. They've got a few kind of other kind of things that are out there. They've got real estate, of course. But they almost, so many of them have zero exposure to kind of tech, up and coming tech, what's going on in tech. And so much of that is driving like the real economic returns.
And that's why you're going to see, that's why now you're agreeing with me, but we see it every day on the demand side of the funds when they go to raise capital, right? We have an LP portfolio here of over 800 venture funds. There's 325 managers. And so when they're raising, we're seeing where the capital's coming from because we're investing in some of these. And we always ask, where's the capital coming from? And it's more and more of it's coming from individual high net worth investors. And it hasn't, that demand that you're citing there hasn't been solved yet. And so that means there's going to be more and more and more of it. I think that the negative of that capital is that sometimes it's not as long term as like an endowment, foundation, pension fund that can have a hold period of 15 years and not ever need liquidity ever. Maybe it's because their capital has more inflows than outflows, right? And they're compounding their capital and it's growing and growing and growing, so they actually will never need a redemption. But on the individual side, there's a lot of need for liquidity. And it's things like death, divorce, mundane things like maybe they want to buy a house, just things like that. Maybe there's they want to fund a wedding or whatever, and they need capital. And
managing the LPs is harder because the good news is diversity is good. So having more customers is better. You don't having just like if you're a tech company and you have one customer that's 20% of your revenues, it's never as good. But so diversity is good, but then of course you have to manage all these customers.
You're going to have a heavy admin burden, right? In the typical LPGP structure you're in, it's a heavy admin burden if you have people redeeming partial stakes, full stakes.
Yeah, and you have to call them and talk to them, and maybe that's a benefit because they can help your portfolio. But there's it's a whole different way of thinking about it rather than having some endowment that's out there, and you go to the University of Indiana or something.
Now we're starting to get on the same page here. That's why the construct of your fund that you're managing is going to change, I think.
Yeah.
Because once your competitors' funds and everybody else's change, then you're going to have to change. Because if I'm an LP and you start pitching me your current structure, I'm going to go, well, why don't I have a liquidity mechanism? Why don't I have a redemption feature? What if I'm going to give you $1 million? How can I just want $100,000 back? Why can't I just do that? Right. I mean, and if someone else is presenting him something that does that and you don't, you might not be
even
able to
the whole
raise
idea of capital calls is weird. It's just now all of a sudden I have this burden and I get this 10% capital call and I have to do it and I have to call my wealth advisor to send the wire. And it's just it's just weird to think about how to do that.
And in a permanent fund structure, when they invest, there's already a portfolio there. Yeah. Right. So they just buy what's there. And so it's not about here's $1, go, I'm going to, draw it down over time, do all these new things. But when you invest into a mutual fund, you buy the basket, right? And as their capital grows, they buy new stocks, move stocks around. So I think that the fund management is going to change too, in terms of how you construct your portfolio, how you add things, the whole manufacturing liquidity aspect is going to change. I think that the venture model in the next 10 years is going to be different than it is today.
I mean, almost certainly. I mean, it's changed so much in the last 10 years, and that change seems to only be accelerating going forward.
And so far, we've been pretty good on our side of the table of predicting trends and things like that. So I hopefully we can be good about predicting trends and things in the future. But I think consolidation is going to be continuing to happen. And I think that the structure of how you raise capital and where it comes from and how your fund is structured and how your portfolio looks is going to change.
Agreed. All right, two personal questions we ask all of our guests. First one is, what is a conspiracy theory that you believe?
So that's pretty funny. I love that one, by the way. So there's that. I'll tell you two. Okay, I'll give you a bonus one. So I do think that people don't understand that your phone has a microphone and is listening to you constantly, because Apple does have the feature on all the time to listen for when you say,
Right, for Siri or
"Hey
something.
Siri" or
Yeah.
whatever.
Yep.
And so I
By the
just
way, just because we said "Hey Siri" right
my
now,
phone
like
just
20 people's phones, like right now, who are listening to
my
this, are
phone
gonna
just
like
lit up.
totally malfunction and
So
mess up.
it actually, see, I just, my phone just lit up with the Siri. So
Totally, yeah.
anyways, yeah. So but if you download no, it's gonna go search for what I'm saying. When you download an application and it's by default microphones on, it's listening as well. And so
Yeah.
I do think that your phone is listening to more of what you're saying on the application side. Maybe you've given permission to applications to listen to you and you didn't realize it. And so
And do you
I
do do
do
you do
believe in this.
anything differently? Are you putting like your phone in like a Faraday cage and
No,
stuff
I
like
kind of
that?
just
Or
I did go in and make sure on all my applications that I had the microphone off if I,
yeah.
wanted the microphone off. I think that's something from a security perspective you should be doing. Because if you have the microphone on, you've consented to be on, they can be listening to you. So I do believe that there is this conspiracy theory of like your phone listening to you and serving you an ad of something you just said. So if I said, "Hey, I'm looking
Yeah.
for a new pair of jeans," and then I'll go look at my phone and there's like, somehow there's a pair for a new pair of jeans.
By the way,
And that,
that would actually be like a feature, not a bug to me, if that
okay.
actually
And
works. Yeah,
since you
yeah, yeah.
understand the
Yeah.
advertising market, you can tell me if my conspiracy theory is wrong or not. But I do believe your phone's listening to you, and I do believe that you should take personal
Uh,
security actions
that's
to
a very
turn
good
off
one.
the microphone. Do you agree with that?
All right, that was you said you have a second one. This was
I
good,
got a
really good.
second one.
Okay,
So
amazing.
I also think that the NSA through their Utah data center is collecting all of your email, all of your phone records, all of your conversations, probably this thing that we're talking about right now because it's not encrypted, and then storing them and going through them for national security. So I do believe that the government is storing browser history, shopping history, travel itineraries,
And do you think
the
they're
whole digital trail.
effective? Like, there's one thing to collect it, one thing actually to like use it and run things on top of it. Do you think actually they're effective at it?
So that's a good question. I don't know. I know that I believe that it's being collected. How
Yeah.
it's being used, I think, there's probably a good set of protocols, procedures around
'Cause
that.
certainly, like, I mean, China was like, there was all these things China was tapping, like Verizon phones and
Yeah.
stuff like that. And, so I'm sure they were
Well,
also
they
on
have
there, like tapping everything, and their Huawei stuff
a
is
hundred
like collecting
percent
as much
that
stuff. They're
a
all
hundred
trying to
percent.
hoover all this stuff,
Yeah,
right?
that's 100% true, right? Otherwise, we wouldn't
Yeah.
have things like TikTok be divested. Um, but yeah, I do believe that there's a lot more monitoring of our society than people might think.
Interesting. All right, last question we ask all of our guests. What conventional wisdom or advice do you think is generally bad advice?
I think a lot of advice is bad. So, but I think one thing that I've been told over time, is like, hey, you should always marry your high school sweetheart. So I think the love advice, I think if you go in bad advice as it relates to like love and marriage,
You should marry your high school sweetheart is bad advice or good
I think
advice?
that's bad advice.
Okay. Well, I've never even heard people say that. Is that like
Oh,
a
really?
common
Yeah,
thing that
that's
people
definitely a
say?
thing.
Yeah.
And I've got a whole bunch of friends who've married them. Maybe it's because I'm from Minnesota and everybody did
Yeah.
marry their high school sweetheart.
It's funny,
Um,
where I live in Northern Virginia, I know 7 couples
yeah.
that married their high school sweetheart, and they're like all amazing couples.
And
Like
they're
it's
still good.
unbelievable.
Okay.
They're
So,
still good, 20 something,
yeah.
25 plus years later. And they're incredible couples. And you look at these people, you're like, wow.
So
Like there's something about,
maybe I
at least in
caveat
Northern
this.
Virginia, marrying a high school sweetheart is a great idea.
So let me caveat that. So I think that if you're still in a more rural area and you're not living in a city, and you've decided that, like, I'm from Minnesota, and
Yeah.
if I would have stayed in Minnesota and I wanted my family in Minnesota, I never wanted to leave Minnesota, and I never wanted to do anything else except for stay there and be there and have a family and everything like that, then maybe marrying your high school sweetheart is a great idea. I think that if you go out into the world and live in different places in different cities and have educated different places and have different jobs, and if you're more of the group of people that are here in San Francisco, I think marrying your high school sweetheart is not a good idea. So,
Hmm.
and that is because people change over time, people evolve, and if you are from a more rural community, you end up living in building your career in New York City, I think the
Yeah.
probability of the person that you were with when you were in the rural community developing as you develop in New York City, I think that's a very low probability of the relationship.
Let me just stress this, because again, I got married later in life, but I've met all these people now who have met their sweethearts when they're 16 years old, or they may have met them earlier, but they started dating them. They went to prom together. And I look at them and they seem like they have like incredible relationships. And like one really cool thing is like they kind of grew up together.
Yeah.
So they kind of like they evolve together. Now, maybe you can evolve separately, and obviously that won't work out.
I
right?
think that's
because
really
people
hard.
do change.
If you stay around the same area that you are in, I think it's a lot easier. I think that it's really hard to have two people coming from, maybe it's like not a city, right? Or a big metropolis. And then moving into that.
How old were you when you got married?
29.
29. Okay. So you're relatively young in this world, even though maybe in some worlds that's old, but you're relatively young to get married.
Yeah. I mean, compared to my peer set, I was like one of the last people to get married, but yeah.
Yeah. Okay. Yeah. Okay. Yeah. But nowadays in San Francisco, I've seen the average age is even older.
30s and it's fine, right?
Yeah. Totally. Yeah.
So I do believe that especially if your career's evolved, if your education's evolved, if you've moved into the larger cities and live more of a city sort of life, I think that the person that you're going to spend your life with that can relate to you and build a family that you also want to build and have that work, I think has to have kind of an equivalent kind of background. I think it's harder to, it's kind of oil and water in a way, I think.
Interesting. Yeah.
That's my opinion.
In some ways, like I think there's a probability that like people will start getting married a little bit younger than they have. Like we might be in peak age of people getting married right now. And especially in some of these cities where you could start to see a trend where people start getting married more in their 20s again, less in their 30s, or even later in some cases that people are getting married now.
But if you go to Japan, it's the reverse, right?
People are getting married even later, or they're not married.
They're not getting married at all.
Yeah. Though Japan is a weird place. So it used to be like the lowest TFR in fertility rate in the world in the 90s, and now they have the same fertility rate as they did in the 90s. Like they haven't changed. So they're now way higher. They're like double the fertility rate of South Korea, way higher than Italy, Spain, most of these European countries. So they're just like Japan. I love Japan. It's like an incredibly interesting and weird place. I think
so it's almost Japan's fantastic.
Yeah, one of my favorite places in the whole world to go to. Well, this has been awesome. I love this last segment because I love talking about love. This has been amazing. Thank you, Hans Swildens, for joining us on World of DaaS. By the way, I follow you at Hans Swildens on X. I definitely encourage our listeners to engage with you there. We've been friends for a long time, and I knew this would be awesome, and this was super fun. So thank you again for being at World of DaaS.
Thank you, Auren. I appreciate it.
Thanks for listening. If you haven't already done so, please subscribe to World of DaaS wherever you consume your podcasts, YouTube, Apple, Spotify, and more. And please help us get discovered by leaving a review. And check out worldofdaas.com. That's worldofdaas.com. And of course, connect with me on Twitter at Auren. That's AUREN. Would absolutely love to hear from you.